Tesla's Q3 2023 performance sent ripples through the stock market as the company reported a double miss, causing its stock to drop by 3.5% in after-hours trading. This weaker-than-expected financial performance didn't exactly come as a surprise, given Tesla's recent delivery miss and the series of price cuts throughout the year. The company's drive for unit volume growth over profitability has led to compressed margins. In fact, auto gross margins for the third quarter were below street estimates, leading to a contraction in free cash flows. It's clear that the balance between growth and profitability is a delicate one, and Tesla seems to be leaning heavily towards the former. The numbers paint a clear picture. Tesla reported revenue of $23.35 billion and non-GAAP earnings per share of 66 cents for the third quarter, both missing consensus estimates. These misses are significant and have undoubtedly contributed to the stock's after-hours performance. But it's not just about revenue and earnings per share. The company's GAAP gross margins fell to 17.9%, revealing a considerable squeeze. On top of that, operating expenses increased by 43% year over year, resulting in a sharp contraction in operating income and free cash flow production. Tesla's focus on delivering approximately 435,000 units in Q3 has been a massive undertaking. However, with this focus on volume, we're seeing a rapid deceleration in revenue growth and deteriorating operating margins. The company's relative valuation is seen by some as out of touch with reality, sparking arguments for both bullish and bearish perspectives on the firm. Despite these figures, Tesla's management remains steadfast in their 1.8 million vehicle production target for 2023. It's a bold statement, and one that we'll be watching closely as the year unfolds. While Tesla's financial performance in Q3 has raised some eyebrows, it's important to consider the risks and opportunities that lie ahead. Let's delve into that. On the risk side, Tesla's strategy of prioritizing unit volume growth over profitability has led to compressed margins. In the third quarter, Tesla's gross margins fell to 17.9%, a figure that's lower than street estimates. This strategy has led to a contraction in free cash flows, putting pressure on Tesla's financial health. Operating expenses also increased by a whopping 43% year over year, resulting in a sharp contraction in operating income. Additionally, Tesla's relative valuation is seen by many as out of touch with reality, creating a divide between bullish and bearish perspectives. However, it's not all doom and gloom. Tesla's commitment to its target of 1.8 million vehicle productions for this year demonstrates the company's ambitious growth plans. Despite the weaker-than-expected financial performance in Q3, Tesla has managed to deliver approximately 435,000 units, keeping it on track to meet its production goal. The real potential for Tesla lies in its autonomous driving technology and data collection capabilities. Tesla's management believes these aspects will drive future growth and could potentially lead to a massive software-as-a-service business. This transition could open up a new revenue stream and significantly enhance Tesla's market value. It's a bold vision that, if realized, could fundamentally change the way we perceive the company. In conclusion, Tesla is a company in the throes of rapid growth and change. Its aggressive push for unit volume growth does come with risks, such as compressed margins and increased operating expenses. However, the potential upside from its autonomous driving technology and data collection capabilities cannot be overlooked. It's a classic scenario of high risk, high reward. Tesla's future holds both potential risks and promising opportunities, making it a fascinating case to delve into. With the Q3 results and future prospects in mind, let's delve into Tesla's stock valuation. Now, Tesla's relative valuation has been an arduous topic of discussion, often perceived as disconnected from reality. There are compelling arguments on both sides of the coin, bullish and bearish, each possessing its own merits. For the bulls, Tesla's future potential is colossal. They argue that the company's autonomous driving technology and data collection capabilities will fuel future growth, and could potentially give rise to a massive software-as-a-service business. This encased potential is seen as a significant value driver and can account for Tesla's relatively high valuation. On the contrary, the bears point out the decelerating revenue growth and deteriorating operating margins. Despite Tesla's remarkable unit volume growth, the company's revenue growth is indeed slowing down rapidly. In Q3, Tesla reported revenue of $23.35 billion, falling short of consensus estimates. This, coupled with the fact that Tesla's operating margins are deteriorating, presents a cause for concern. In fact, the company's GAAP gross margins fell to 17.9%, and operating expenses surged by 43% year-over-year. This resulted in a severe contraction in operating and free cash flow production. These are notable red flags that warrant caution. According to our valuation model, Tesla's fair value is approximately $180 per share. With the stock trading at roughly $242 per share at the time of creating this video, it is currently overvalued by nearly 26%. Now, we are willing to pay a premium for a high-quality company like Tesla. However, the question arises, is the risk/reward attractive enough to justify an investment at current levels? This brings us to the crux of the stock valuation debate. It's a multifaceted equation. The company's future prospects need to be measured against its present challenges. Tesla's high valuation is contingent on its potential to disrupt the automotive industry and beyond. However, current financial performance and market realities call for a more grounded assessment. The discourse on Tesla's stock valuation is ongoing, mirroring the complexity of evaluating this trailblazing company's worth. After considering Tesla's Q3 performance, the risks and opportunities, and the ongoing debate around its stock valuation, it's time to present a final recommendation. Tesla's financial performance in the third quarter of 2023 was not as promising as anticipated, with a double miss that led to a 3.5% drop in after-hours trading. The company's revenue and non-GAAP EPS fell short of consensus estimates, and auto gross margins were lower than expected. This resulted in a contraction of free cash flows, which is concerning for potential investors. However, it's important to remember that Tesla is still on track to meet its vehicle production goal of 1.8 million for 2023. And despite the current challenges, the management remains optimistic about the future growth driven by their autonomous driving technology and data collection capabilities, which could potentially lead to a massive software-as-a-service business. On the other hand, Tesla's rapid deceleration in revenue growth and deteriorating operating margins raise questions about its current valuation. The company's relative valuation has been seen as out of touch with reality, sparking debates among investors. So, what's the final verdict? Well, it's a bit of a mixed bag. Tesla's current financial performance and market valuation present significant risks, but the company's potential for future growth cannot be ignored. Therefore, the recommendation would be to hold Tesla's stock for now. If the stock price falls below $180 per share, buy some extra. If the price gets over $300, sell and make some profit. But let's not overlook the fact that investing in the stock market is a personal decision that should align with your financial goals, risk tolerance, and investment strategy. It's crucial to stay informed about the latest developments, maintain prudence in your decisions, and remain open to the dynamic nature of the stock market. Whether to buy, sell, or hold Tesla's stock ultimately depends on your risk tolerance and investment strategy. Stay informed, stay prudent, and stay open to the dynamic nature of the stock market. Let's take a quick look back at the key points from today's discussion on Tesla's Q3 performance. Firstly, we discussed the Q3 results in detail. Tesla reported a double miss for the third quarter of 2023, leading to a 3.5% drop in stock during after-hours trading. The company reported revenue of $23.35 billion and a non-GAAP EPS of 66 cents, falling short of consensus estimates. Despite these numbers, Tesla remains on track to meet its vehicle production goal of 1.8 million units for 2023. Next, we dove into the risks and opportunities. The company's operating expenses have increased by 43% year over year, resulting in a sharp contraction in operating income and free cash flow production. The relative valuation of Tesla's stock is seen as disconnected from reality, presenting both bullish and bearish perspectives. However, Tesla's management maintains faith in their autonomous driving technology and data collection capabilities as key drivers for future growth and a potential massive software-as-a-service business. We then move to the stock valuation. Tesla's revenue growth is decelerating rapidly, and operating margins are deteriorating. Yet the company's auto gross margins for Q3 were below street estimates, leading to a contraction in free cash flows. This dynamic puts pressure on the company's valuation, making it a point of concern for potential investors. Finally, we arrived at the recommendation. Given the current financial performance and future prospects, we believe that investing in Tesla requires a careful consideration of these factors. We recommend keeping a close eye on Tesla's progress towards its production target and its ability to manage costs while driving growth. Remember, informed decisions are the best decisions. Keep digging into the data and stay tuned for more insightful analysis.